All right, today we are opening up the playbook for UK small business tax. This is the stuff that can help you legally keep more of the money you work so hard to earn. So let's just dive right in.
Okay, let's just start with the big one, shall we? Are you paying too much tax? Look, for most people running a limited company, the answer is almost certainly yes. And it's not because you're doing anything wrong. It's because being tax efficient, well, that doesn't just happen by accident. It's a strategy.
And that really is the key, isn't it? It's all about planning, timing, and really getting your head around the rules from HMRC. That's the UK's tax authority. And let's be honest, they don't always make things crystal clear. So today, we're going to pull back that curtain and show you how to use those very same rules to your advantage.
First up, we're talking about the salary versus dividend secret. And honestly, this is the most fundamental one of them all. It's all about how you pay yourself. Just getting this one decision right can put literally thousands more pounds back in your pocket every single year.
So, you've got two main ways to pay yourself, and the difference? Well, it's huge. A salary? That's a business expense, so it lowers your corporation tax bill, which is great. But it gets hit with both income tax and national insurance. Ouch. Now, dividends, they don't have any national insurance, but here's the catch. They're paid out after your company has already paid its corporation tax. And that little distinction, that's exactly where the magic happens.
And wow, look at this. This just shows you the real-world impact perfectly. Let's say you want to take £50,000 out of your company. If you do it all as salary, the total tax hit, and that's your income tax, your employer's national insurance, and the company's employer's national insurance, it's absolutely massive. Now compare that to the tiny little sliver of tax you pay using what we call an optimal mix. I mean, the difference is just staggering, isn't it?
In fact, the difference is this number, over £15,000. By structuring your pay the smart way, you could have an extra £15,281 in your pocket. Same company, same profit, just a smarter way of doing things. So, the big question is, how do you actually do it?
Okay, it all starts with this magic number right here. For the current tax year, the absolute best annual salary for most company directors is £12,570. Now, this isn't just some random number we've pulled out of a hat. It is the precise sweet spot in the UK tax system.
So, why this number? Well, it's so clever because it uses up your entire tax-free personal allowance. That means zero income tax is due on it. It's also perfectly positioned just below the line where you'd have to start paying both employee and employer national insurance. And, this is the really crucial bit, it's still high enough to count as a qualifying year for your state pension. It literally ticks all the boxes.
So the playbook here is actually incredibly simple. Step 1, you set your own salary at exactly £12,570 for the year. And step 2, you take any, and I mean all, further income you need from the company as dividends. They're taxed at a much lower rate, and remember, no national insurance. Simple as that.
All right, next up, let's talk about what is, without a doubt, the single most powerful tax relief tool available to any UK business owner. And that is your pension. You've got to stop thinking of this as just a retirement plan. It is the ultimate tax shelter. You know, you can fund a pension personally from your own bank account, but honestly, a much better way is to have your company contribute directly. It's almost always the superior choice. Why? Well, the company gets to deduct the full contribution from its profits, which saves a chunk on corporation tax. And for you personally, no income tax, no national insurance. It means more of your money goes straight into your retirement pot, completely tax-free. It's a total no-brainer. And here's a little secret weapon that most people don't know about, the carry-forward rule. This is amazing. It lets you use any unused annual pension allowance from the previous 3 tax years. So let's say you've had a really great, profitable year. You could potentially make a massive tax-deductible contribution, basically going back in time to use up allowances you missed out on. It's like a tax time machine.
Okay, our next strategy is all about finding hidden money. We're talking about tax relief that you are absolutely entitled to, but that so often just goes completely unclaimed. It's hiding in plain sight, in the assets your business has already bought.
So, how do you find this hidden money? Well, it's through something called capital allowances. Think of it as tax relief on your business assets. And thanks to something called the annual investment allowance, you can often deduct 100% of the cost of qualifying assets up to £1 million in the very same year you buy them. But here's the crucial point. This relief isn't automatic. You have to actively claim it. So what kind of stuff can you claim for? Well, it's not just the obvious things like vans and laptops. We're talking about things you might not even think of, like software licenses, the costs of getting your website developed, office renovations, even fixtures and fittings like new lighting or a security system. So many business owners miss these entirely.
And check out this example with company cars. It just shows how powerful this can be. Let's say you buy a 40,000-pound electric car. You can claim 100% of that cost in year one, saving you a massive 7,600 pounds in corporation tax. Now look at a diesel car for the exact same price. The saving? Just 456 pounds. I mean, the choice is pretty clear, right?
So let's kind of bring all of this together. The biggest takeaway from all of this is to stop thinking about tax as this once-a-year headache. Real, meaningful tax efficiency. It comes from having a year-round plan.
And this quote just says it all, doesn't it? The business owner who only looks at their tax situation once a year is always going to pay more than the one who treats it like an ongoing strategy. The people who keep more of what they earn are the ones who are thinking about the tax impact of their decisions all year long, not just when a deadline is staring them in the face. It's all about being proactive.
And let's be really clear about something. This stuff isn't about finding sneaky loopholes or trying to pull a fast one. It's about intelligently using the structures and the reliefs that the government has literally created to encourage you to do certain things, like investing in your business and saving for retirement. You're not being sneaky. You're just being smart.
So, we'll end with this final thought. We've just seen how a little bit of planning, maybe an hour of your time, can genuinely save you 15,000 pounds, or even more. So the real question is, what are you going to do with it? Is that a deposit on a house, an amazing family holiday? Or maybe you reinvest it to grow your business even faster. That is the real power of having a smart tax strategy.